I'd like to chat briefly about this document and the charts that are with it. I'm going to accentuate a little bit of what Brian said, okay? And I'm going to use this because I noticed I was sitting at the back there, and it's rather difficult to see this screen from back there. So this first page, I'd like to see, does anybody recognize anything specific that happens on this page? It happens every year. Anybody see there's something that happens every single year on this graph. The market drops. There's a red dot everywhere here. There's a red, so every single year the market is down below where it started off. All right? What this picture is showing you is that on average, the S&P 500 drops on an annual basis 14.2%. So every year, on average, it drops about 14.2. If you look at 2008, you'll see that it dropped 38%. If you look at, 2013, at one stage it was down 6% and it finished up 30%. So every year you can expect a drop. When I read Brian's piece and we wanted to try and put this thing together, one of the things that I had in my mind was almost like a lifeboat drill. What do I mean by a lifeboat drill? Well, if we look at the 90s, let's go back and go from about 1994 to 1999, you'll see that the returns there are consistently up. And this is when people are thinking, oh, we're going to get 14, 15% rates of return. The city of San Diego changed its actuary to say, okay, we're not going to get 8% returns in stocks, we're going to get 15. They changed it. We know what happened next. Now, the other thing that I'm finding is that a lot of people, back here they were expecting 15% rates of returns because of this and this, now they're expecting 3 or 4% rates of return. If you look over the long run, you'll see that you're averaging around about 10%, as Brian said. But again, it's been a little while since we've had a dip. If you look at those last few years, it's been since 2011 since we had that 19% drop. So it's been a little while. Am I saying the market's going down? I don't have a clue. And anybody that says, if you ever met anybody that looks into the future, they're lying, because no one I've ever met in 60 years of being on this planet can look into the future. I do not have a clue. But I'm saying, hey, if it happens all the time. All right? Let's look at the next page. And these are the historical returns by holding period. So if I held a portfolio of 100% stocks, the S&P 500, and I held it for a year, the worst year I'd have been down 37%. What year was that? That was 2008. My best year I was up 51%. I don't know what year that was. Okay, if I held bonds for a period of 1 year, the worst year I would have picked out would have been probably 1994. Is my guess, down 8%. My best year, up 43%. And then a balanced portfolio of stocks and bonds, 50-50, would be, my worst scenario would have been down 15%. My best scenario would have been up 32%. That's for 1 year. Let's bring it over here to 20-year rolling periods. What do I mean by 20-year rolling periods? What I mean there is, okay, the 10-year rolling period would be 1951 to 1951 to 1961, 1952 to 1962. They would be 10-year rolling periods. My worst year would have been down 1%. My best year would have been up 19%. On a balanced fund, my worst year would have been up 2%. My best year would have been up 17%. So you can see, the longer we hold the assets, the more stable it becomes, so to speak. If I hold it for a 20-year period, okay, my best annualized returns, my best 20-year annualized returns would have been an annualized return of 18%. My worst would have been 6. So the very worst I would have done if I'd held the S&P 500 for a 20-year period from 1950 to 1915 would have been 6%. So you're thinking, well, why wouldn't I? If that's my worst case, my best case is I'm up 18, my worst case is I'm up 6, why wouldn't I just do equities? Exactly the way Brian said, okay, do you really think you would have done that when that happened? And that's the question you have to ask yourself. If you'd said, okay, I'd have left it in there, been fine, and maybe added, fine. But if you think you would have had heartburn, gray hair, or wrinkles, then, again, the more balanced portfolio is the way to go. Okay? Finally, and a lot of you guys are familiar with this particular program. This one at the top here just shows you if you had 100% in equities, you're down that much. If you had a balanced fund, you would have been down to here. Okay, and when you break even, when the 60-40 portfolio breaks even about here, it is what, December, maybe November 2010. The 100% stocks breaks even here at about, looks to me like about May of 2012. And they pretty much finish up the end. But again, you're down quite a lot less. So the anxiety that you would have felt on September the 28th, 2008, was that it? Yep. Oh, was it? Yeah, okay, wouldn't have been quite so bad. More importantly, in my opinion, far more importantly, is this. And this is as Brian just alluded to. If we'd known, can I get my glass of water? Yeah, my glass of water. I feel like, what's her name, Rubio? Thanks. I've got allergies. Thanks a lot. What'd you do, bud? Okay, got it. So if we'd known 20 years ago where the very best place to put our money would have been real estate investment trusts. As an aside, that would have been those volatile investment we could have chosen. But nevertheless, 20% we'd have got, and we'd have averaged about 11.5% on an annualized basis if we put our money there. The S&P 500 did 9.9. A balanced fund did about 8.7. Bonds did about 6.2. And bonds are not going to get 6.2 in the next 20 years. Interest rates have gone from here to here. It is impossible to replicate that. Gold would have averaged 5.9. Oil 5.7. International stocks 5.4. Homes 3.2. The average investor. Can you go back to this, not the previous slide? One more. The average investor, and I'm picking up on what Brian said, the average investor. I remember guys knocking my door down. I got to get this money invested. I had specific memories of, I need to get my money invested. One guy said to me, we're losing money because you're not investing my money right now. I remember that vividly, okay? Then here they're saying, oh no, the end of the world is coming, the end of the world is coming. Again, the Time magazines. You might have recognized one of the Time magazines on my credenza. I know my credenza is covered with stuff. But there is one of the Time magazine's covers right there on my credenza. People were trying to get as much money as they possibly could in here, and then panicking here and here. And that's what you got to remember. Okay, going back to that, thank you, Steve. There's the average investor. All you got to do is sit tight, and again, something along these lines, we should be just fine. Any questions on that material? None whatsoever? Okay, let's go into the blue booklet again, here. And again, I want to go to the left-hand side. And we're going to briefly cover some tax law changes that I think are important. And to me, the key one, the very key one that you want to bear in mind, you want to always remember. Do you remember back in the 80s when we had IRAs and we'd roll them over from one bank to another? We'd get 12% at one bank and 13% at another bank. We'd roll them over. We'd get the check from the bank. We'd walk it over to the other bank and put it into that bank. Do you remember doing that? Who remembers doing that? Anybody? Okay, thanks a lot. Appreciate that, Norm. You get your money at the end of the day. Okay, you don't want to do that anymore. You don't want to do a rollover anymore. The IRS have changed the regulations, Congress have changed the regulations, that from now on in, you can do one rollover. If you do a second rollover, that's considered to be a distribution that would be subject to tax 100%, and if you're under 59.5, subject to a 10% penalty. So bottom line is, if you're thinking about doing any sort, if you can do transfer to transfer, let's say you take your money and you transfer it from Merrill Lynch to Severn Financial Advisors, as you should. Let's say you did that, you transfer it from entity to entity, you can do it fine. If you transferred it from Severn Financial over to a different outfit, again, you can transfer to transfer as long as you don't have that hot little check in your hand. The critical thing is you don't want that check in your hand. As many transfers as you like, but the rollovers where you actually take the cash, have the money in your hand for 60 days, you want to limit it to one. Frankly, if you're thinking about doing it, I'd call your financial advisor, hey, look, this is what I'm thinking about doing. What do you think? Okay? Or your tax advisor. Martha's right here. She can help. Call your tax advisor if you can't call one of us and ask them what their thoughts on that. Okay? But that's pretty much a no-no. That's the big one. The rest of them are pretty straightforward. The next page, you have higher contribution limits for your 401ks. your 403Bs, your 457 plans, and the thrift savings plan for your government employees. You've still got the $6,000 for the additional monies for folk that are 50 and over. There are higher income levels for your IRA contributions. They're all pretty straightforward. They're pretty much indexed with inflation. So if you want to make contributions to your IRS, higher income levels for your Roth IRA contributions as well. And again, these are indexed with inflation. And there are some changes in your healthcare expense accounts. You might want to look at that. But I would say they're the key ones. The other one would be that the exemption that we don't have written in here, the exemption for Maryland in your estate tax has gone from $1 million up to $1.5 million. I'd like to have that in here. It was an oversight. If you've got questions on that, give us a call. We can go over that with you as well. Okay? Any questions on any of these tax laws, your IRAs, anything along those lines? Okay, well, twice today I heard Patrick Hutchinson is not going to speak. He's going to speak on Social Security. Okay, you need to concentrate on this. That's all I can say. It's very, very good. It's well worth it.